Here is a number most home buyers never calculate. On a $400,000 home loan at 7% interest, over 30 years, you will pay nearly $300,000 in interest alone. That is $300,000 that never builds your equity. It simply goes to the bank. This is the hidden truth about mortgages, and understanding it is the most important financial education you can get. A mortgage is, at its core, a simple instrument. You borrow money to buy property, and you repay that money over time with interest. But the mechanics underneath are far more consequential than most borrowers ever realize. When you take out a 30-year mortgage, every monthly payment is split between two things: interest and principal. In the very first month of a $400,000 loan at 7%, your payment is roughly $2,600. Nearly $2,300 of that goes straight to interest. Only about $300 actually reduces what you owe the bank. This ratio shifts slowly over time through a process called amortization. By year 10, you are paying about $1,800 per month in interest. By year 20, closer to $1,100. It is only in the final decade of the loan that you are actually paying down the majority of your balance. The front-loaded interest structure is by design, and it is why banks love 30-year mortgages. Run the full numbers, and the picture becomes clear. On that $400,000 loan at 7%, the total repayment over 30 years approaches $750,000. Less than half of what you pay touches your actual debt. But interest is only the beginning. Let us talk about everything that actually makes up the full cost of buying and owning a home, because first-time buyers consistently underestimate this number, sometimes by hundreds of thousands of dollars. Start with private mortgage insurance, or PMI. If you put down less than 20% on a conventional loan, your lender requires PMI. This insurance does not protect you, it protects the lender. Depending on your loan size and credit profile, PMI costs between 0.5% and 1.5% of the loan annually. On a $400,000 loan, that is $2,000 to $6,000 per year added to your payment, continuing until you reach 20% equity. Then there are closing costs. On the day you sign your loan, you will typically pay between 2 and 5% of the purchase price in closing fees. Origination charges, title insurance, appraisal fees, attorney charges. On a $400,000 home, that is $8,000 to $20,000 due immediately. Then comes what most buyers forget entirely, the ongoing cost of ownership. Industry guidelines suggest budgeting 1 to 2% of your home value each year for maintenance. A new roof, an HVAC replacement, a failed water heater. These costs are invisible until they arrive, and they always arrive. When you total it all, 30 years of principal, interest, PMI, taxes, insurance, and maintenance, the true cost of a $400,000 home purchased with 10% down can exceed $1.3 million. Here is where the story shifts. If the 30-year mortgage is the system, refinancing is the most powerful tool available to work within it more intelligently. Refinancing means replacing your existing mortgage with a new one, at a different rate, a different term, or both. When interest rates fall meaningfully below what you are currently paying, refinancing can change the entire financial trajectory of your loan. Consider this scenario. You took out a $400,000 mortgage at 7%. Your monthly payment is $2,600. Rates move lower, and you refinance at 5.5% on a new 30-year loan. Your payment drops to $2,300 per month. That is $300 saved every single month. Over the remaining life of the loan, more than $100,000. But refinancing is not free. Closing costs on a refinance typically run 2 to 3% of the loan balance, another $8,000 to $12,000. This is why lenders discuss the break-even point. Divide your closing costs by your monthly savings. If you save $300 per month and pay $10,000 in closing costs, you break even in about 33 months. If you plan to stay in the home beyond that, the math works in your favor. Some borrowers refinance specifically to shorten their loan term. Moving from a 30-year to a 15-year mortgage means a higher monthly payment, but you pay off the home in half the time and eliminate hundreds of thousands in interest. Others use cash-out refinancing to access their built-up equity for major investments or expenses. The key principle is this: your mortgage is not a fixed sentence. It is a financial product you can renegotiate as market conditions change. Not all mortgages carry the same terms, and the loan you choose at the beginning shapes everything that follows. The fixed-rate mortgage is the most straightforward option. Your rate is locked for the entire loan term, 15 or 30 years. Your payment never changes, regardless of where interest rates move in the market. This predictability is its core advantage. The adjustable rate mortgage, or ARM, begins with a lower rate that adjusts periodically after an initial fixed period. A 5/1 ARM means your rate is locked for 5 years, then adjusts annually. ARMs can make sense for buyers who plan to sell or refinance before the adjustable period begins. But they carry real risk if rates rise and you remain in the home. FHA loans backed by the Federal Housing Administration serve buyers with smaller down payments or lower credit scores, as little as 3.5% down. But FHA borrowers pay mortgage insurance for the life of the loan, not merely until they reach 20% equity. And VA loans, available to eligible veterans and service members, stand alone as the strongest mortgage product on the market for those who qualify. No down payment required, no private mortgage insurance, competitive rates with full federal backing. Understanding these distinctions and matching the right loan structure to your specific financial situation is frequently the difference between a mortgage that builds wealth and one that drains it. There is one more piece of this picture that most borrowers never see. When your bank originates your mortgage, it typically sells that loan within weeks to the secondary mortgage market, to government-sponsored entities like Fannie Mae and Freddie Mac, which bundle thousands of mortgages into securities sold to investors worldwide. Your bank earns an origination fee up front and often retains servicing rights, collecting your monthly payments and earning a small fee on every dollar. The risk of whether you will repay has been transferred to investors. The bank's incentive at the moment of origination is to close loans, not necessarily to find you the most favorable terms. This is why shopping your mortgage across multiple lenders is among the highest return financial activities available to a home buyer. A 0.5% difference in your interest rate translates to more than $30,000 over a 30-year loan. Get at least 3 quotes. Compare annual percentage rates, not just the headline rate. The difference between the best and worst offer available to you is real money. Understanding how mortgages truly work, how interest is structured, how refinancing functions, how to read a loan offer, gives you something most homebuyers never have: genuine leverage over the largest financial decision of your life. Subscribe to the Loan Desk. Every week, we break down mortgages, refinancing, and the real cost of borrowing, so you can make smarter decisions with your money.